Good afternoon and welcome to the European Assets Trust PLC, the Way Forward investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Francis Ellison, Client Portfolio Manager responsible for European equities. Good afternoon.
Good afternoon. I'm joined today by Minna Tezgul, a manager of the European Assets Trust, for a review of the trust and to discuss the exciting prospects for the fund. Minna, tell us a bit about yourself. What's your background and why did you choose small cap in Europe as your speciality?
Hi, Francis. Glad to be here today. So since childhood, I have always been extremely curious about economics and business. That interest led me to pursue an economics degree at the University of Chicago. I started my career 20 years ago in investment banking in New York. Analyzing companies as an investment banker made me realize my passion lied in investing rather than advisory. And since then, I have been researching and investing in developed market equities. I joined Columbia Threadneedle in 2018, and I have been focusing on European smaller companies, managing portfolios investing in this universe. European smaller companies is a compelling asset class. The stocks tend to be less well known and less well understood by the general investment community. Our focus and our research help us uncover attractive investment opportunities.
Thank you, Minna. Minna, small cap in Europe has had a hugely successful long-term history, but the last couple of years have been more challenging. Why is that? And how are things shaping up for the future? Why Europe right now and why small cap?
It's important to talk about Europe in a wider context. Considering 70% of the world market capitalization rests in the US, a comparison with US equities is informative. The divergence in performance and in valuation of the American versus European markets has been staggering. As you can see here, US equities have soared to their most expensive level, both in historical context and in relative terms. The extra compensation an investor would demand for owning stocks, called equity risk premium, has fallen to its lowest level in a generation. As the slide shows, valuation for US stocks do not offer much of a risk premium, whereas European stocks offer the highest relative risk premium in many decades. Moreover, the strength of the US stock market being fueled by a small number of stocks all in the same sector and comprising nearly a third of S&P market cap creates significant concentration risk, similar to putting all eggs in one basket. At some stage, general investors must look more broadly for opportunity, and we believe Europe is one of those attractive destinations. Within Europe, smaller companies offer even higher risk premium compared to larger peers. Although over the long run, smaller companies have generated far superior returns, there has been a major pause in the strong performance of small cap. The reasons are, we believe, more macroeconomic than to do with problems at individual stocks. And we believe the tide has turned. So we can turn to the next one. Inflation is much more under control. Interest rates have been cut and will fall further. So the damage to valuations, as you can see here, could reverse. The negative impact of the last few years on small cap was more exaggerated than large cap and may, for those reasons, reverse more quickly. Flows into the asset class have also been a headwind, which could reverse for the same reasons. And in the meantime, the good underlying performance of our high-quality companies can continue without feeling any major effects from the stock market turbulence.
Meta, that's really interesting. But what about geopolitics? We've a war in Europe and political changes in the US. which are pretty drastic. And we've got elections coming up in Germany and France. How does this affect your views on the market? And what about the companies that you invest in? And how does the European economy look right now?
Yeah, very good question. Economic growth in Europe is subdued, but there is some variation across economies, across countries. Political change in some countries creates uncertainty. We are not too concerned about this as our companies tend to generate their revenues more globally and hence not so sensitive to such change. Where we have domestic exposure, we favor those regions that have better fundamentals, such as the periphery. The new US administration's policy on trade can have a negative impact on world trade, and there could be European exporters affected. Moreover, tensions with China can escalate too. But some Trump policies may also be positive for Europe. His goal of ending the war in Ukraine would provide a tailwind in lowering risk premium, stimulating rebuild, and combined with his deregulation of energy and increasing US LNG exports objectives, likely leads to lower gas prices in Europe. So we have carefully factored these into our stock selection and analysis and have raised these in discussions with the companies we're meeting. All of that creates a bit of uncertainty and in turn causes volatility, which actually can generate attractive investment opportunities. When a rising tide doesn't lift all boats, one needs to be more selective, and this presents a good environment for stock picking.
Thank you, Mine. Mine, you've managed the trust since May of last year, 2024. How is your approach different from what happened before and other managers who offer similar trusts in this field?
Yes, as you say, whilst I'm relatively new to the trust, I'm not completely new to European smaller companies. Together with my team, I manage approximately 4 billion sterling of European small cap assets. What we bring is a new approach, but still looking for high quality business models. We are quite disciplined on this focus. By this, we mean buying business models with sustainable and predictable future earnings derived from selling goods and services which others struggle to match. For example, patent protected technologies or strong brands can create barriers to entry. We use the 5 forces model from Harvard Business School to find companies that fit these criteria and also assess the economic moat which protects a company's market position using the competitive advantage framework.
That's really good, thank you. But so what has this meant in terms of changes to the portfolio since you took it over? What stocks have you bought and sold? And how's the portfolio changed in overall shape?
Even before I took over the trust, it was gaining the benefits of the merged larger management company, greater resources, and a more focused approach. But there has been work to do. So we went through a period of reviewing all positions. Some of them didn't meet the quality and or the valuation characteristics we would be looking for. We have added names in which we have high conviction and sold off those that were either riskier with less certainty and relatively lower on the conviction scale. I can give a few examples. So soon after we took over, we divested the position in Remy Cointreau. While the company was a holding we historically held and liked, the change in the underlying fundamentals in terms of organic growth trends for the foreseeable future suffers from cyclical but also some structural shifts in demand, such as luxury shaming and weak health of consumer in China, inventory stocking in the supply chain post-COVID, their position in the pricing architecture of the industry, combined with evidence around consumer behavior changes with regards to alcohol, especially in the US. And again, such a rich valuation made us decide that we have better opportunities elsewhere. Another example of change would be, for some years, the trust has held a position in Azimut, a specialist Italian fund manager business. The market in Italy has become more competitive and more digitized. And Azimuth is, in our view, not as well placed on the pricing curve or technological investment to benefit from these changes, also relatively smaller in scale to compete effectively on a world stage. Fineco Bank is a larger business and offers not only a fund distribution platform, but access to banking and other financial services online. Fineco has cost advantages over traditional Italian financial services firms, which have labor-intensive client servicing offerings paid by higher fees. The company has well-invested tech stack. More cost-sensitive clients perceive that they can access a cheaper service from Fineco, who are able, via their scale and reach, to negotiate good fees with third-party fund providers. Because of this, they have been gaining market share rapidly, and their model is capital light, enabling high returns on capital. So we have added Fineco Bank as a high conviction call there. We also invested in Konecranes, which has since reported strong results driven by good performance across all business segments. Konecranes is involved not only in cranes, but also in the wider business of port installation, where it has gained market share as many Western clients are unwilling to use their Chinese competitors. As the leader in cranes, lifting equipment, and maintenance services, we see the company benefiting from continued trends of automation and electrification in various industries. With continued operational improvement and growing services in the mix, the company managed to expand its EBITDA margins from mid-single-digit percentage levels to low teens percentage levels over the past decade, and we see this trend continue towards mid-teens by end of this decade.
Thank you, Mina. That was very detailed. Mina, the trust has a very attractive yield paid to existing investors. How can this be sustained, and how does it impact the way that you pick stocks in the portfolio?
The underlying objective of the trust remains unchanged. Firstly, we aim to deliver strong long-term returns ahead of the index. Secondly, we aim to continue with a strong distribution policy, so 6% of the NAV being paid back to shareholders in the form of quarterly income payments. So the income policy is a firm, unchanged policy agreed with the board. Because of the financial situation of the trust, it can be taken from capital, and this means that we can maintain this key policy without compromising in our search for quality. Even though the income stream for investors is high, it doesn't force us to seek companies or to only seek companies with high yields, which might be of lower quality or without growth prospects.
Thank you for that. Tell us a little bit more about your process. How do you find the best small and mid-cap companies in Europe? And how do you avoid the obvious pitfalls?
We look for companies that have an economic moat, a competitive advantage that's difficult to replicate. We also look for exposure to growth, and we look for underappreciated growth. The management teams that we partner with are capable managers and prudent asset allocators. In terms of avoiding pitfalls, we shy away from empire building. For instance, managers who prefer growth at any price, putting companies' long-term prospects at risk, or namely those whose incentives don't align with shareholders. We tend to invest in businesses with large, defendable, and often expanding market shares in their niches. These businesses have pricing power. Our quantitative and qualitative analysis helps us avoid the pitfalls. We analyze industries. We find consolidating industries appealing and commoditizing ones unattractive. We also analyze companies in detail to determine long-term winners. We avoid those that don't have sound fundamental drivers or those that are at risk of increasing competition or disruption. We maintain a valuation discipline. We calculate a fair value for the business with sensible assumptions in our proprietary financial modeling and make an investment decision based on the resulting risk reward. So, for instance, to purchase if the market price is meaningfully lower than our fair value.
That's very clear. Thank you very much indeed. Can you give us a couple of examples of stocks that you like, perhaps in the nature of the process that you've just described? Thank you.
Yes, of course. So I already talked about Konecranes, but maybe interesting to give some color on Rheinmetall. So within industrials, this is a new position that we have introduced to the trust. And the thesis is basically the following. We believe defense spending growth globally will be structurally higher than discounted by the markets. Russia's invasion of Ukraine acted as a wake-up call, which has created a shift in the European mindset, such that Europe's peace dividend, in our view, has ended, and defense spending as a percentage of GDP is on the rise. Increase in spending being mostly in equipment puts a multiplier effect on that. And furthermore, growth outside of Europe can also be significant with demand from Middle East and Asia. So the visibility of demand here is well into the next decade. And as the leading incumbent in ammunition, armored vehicles, and software, Rheinmetall can increase its market share within this picture with strong returns thanks to its intellectual property and market position. Another example I can provide within the materials space is Heidelberg. We believe construction demand will be strong for many years to come. Housing shortage is a universal problem. The capex needs in non-residential markets are vast, thanks to deglobalization, energy transition, and digitization, all exacerbated by years of underinvestment in infrastructure. Structural growth in US construction markets looks well underpinned through to 2030, with strength in reshoring and infrastructure programs in place. And Europe was dire last year, but signs of stabilization are showing, which should see volumes inflect with a return to pricing growth in 2025. And it's remarkable that pricing power has extended despite weak volumes and lower input prices, allowing operational leverage from lower volumes to be absorbed. Given their geographic exposure and strong market position, we believe Heidelberg is well positioned to benefit from these positive developments.
That's been a very good picture of where we are at the moment. Should we just touch a little bit on the future? That's the title of the webinar, and investors are clearly looking to the future. What of the future for European small cap? What should investors expect from your style of management and from the market and the portfolio that you've chosen?
We believe the outlook for the investments held by the trust is strong. We expect short-term economic growth in Europe to be slow, but to pick up in the second half of 2025 and further out. This, in our view, will be a consequence of interest rate cuts, boosting economic activity, particularly with regards to spending and capex investments. At the same time, interest rate cuts will be more modest in the US, which means relative to US equities, Europe will appear more attractive, and the strong dollar, which may result, would be good for European competitiveness and boost the value of repatriated earnings from overseas. Our high-quality companies should drive good earnings per share and returns on equity, and their valuations will be more attractive with lower interest rates, attracting investors to European equities and back to smaller and mid-cap stocks in particular.
Thank you for that. I think Paul will just enable us to hand over to Q&A. This is very much your time, so please post questions via the screen facility, and we will answer as many as we can, and we'll answer them anonymously, so your name won't be highlighted.
Fantastic, Francis. Thank you very much indeed for updating investors. Ladies and gentlemen, just to echo that, please continue to submit your question just using the Q&A tab situated on the right-hand corner of the screen. But just while the team take a few moments to review those questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Francis, as you can see, we've had a number of questions submitted throughout today's presentation, and thank you to the investors for submitting those. Could I please just ask you, where appropriate to do so, to read out the question, deliver the response, and I'll pick up from you at the end.
Yep, I'll do that. So the first question that's come in, when it comes to stock selection, how large is the universe of small and mid cap, and how do you filter and engage with companies, and what are the catalysts for entry and exit? So a number of strands for that. Minna, perhaps you'd like to cast some light on
Sure,
that.
yeah, a couple of questions at once. So I think the first part was with regards to the size of the investable universe. Is that right?
Yes, that's correct. Yeah.
Yeah. So when we think about our investable universe, we considered the the market cap of the top constituent of our benchmark index as kind of the ceiling of our universe. So anything below that market cap would be investable, which means thousands of companies to choose from doesn't create a shortage of opportunities per se. What was the second part of the question? Sorry, Francis.
The second part is how do you filter and engage with companies, and then catalysts for entry and exit?
Yeah, absolutely. So in terms of idea generation, which is kind of what this is alluding to, we follow a process that probably encompasses many different methods. It would be, first of all, our understanding of the current developments within industries and how that reflects onto companies. So from there, we have an idea of which areas are attractive to invest in. We do use quantitative and qualitative screens when we think about the next idea. And we maintain a focus list, a watch list of companies that could potentially be interesting at the right valuation for us. So I would say it is a very dynamic and a ongoing process that we deploy in terms of stock selection. We meet with many companies throughout the year in conferences, in one-on-one meetings, virtually, which is all part of our rigorous research process. And within that, when we identify a winner, then we would be doing the proprietary work, both in terms of thesis formation and financial modeling. And then if the result, as I explained previously during the presentation, if the result is an attractive risk reward, then we would be taking a position. And the last part of the question, sorry, Francis?
Was catalyst, what makes you buy and sell a stock? What's the trigger?
Okay, so for us, the trigger is one, the fact that on a quality basis, the company meets our criteria. And then secondly, on a valuation basis, it provides an attractive investment opportunity. So when we see that, we would consider investing in the company. In terms of a sell trigger, it's either because we believe that the valuation far surpasses the underlying fair value, or we think this thesis that was previously thought to be true was broken. So a thesis value a violation may cause us to sell the company.
That's really good. Thank you for that. Second question, we're moving on to macroeconomics now. So inflation in the Eurozone, is it just under control because there's so little demand and it's weak? And secondly, we've had lower interest rates in the past, and it hasn't worked to stimulate the European economy. So what's going to change that now?
So to the question of is inflation, I think, well, it has to be said, if we consider about the forces that drove inflation to be so high, a big part of that was the war in Ukraine and the resulting energy price inflation. So in a way, it was kind of caused exogenously to the economy. So the falling inflation from that perspective is probably positive because it's less prohibitive for investment and growth. Now, part of the reason why inflation is falling is thanks to monetary policy. So if monetary policy does become more accommodative, I think there are certain, I'm not saying all of Europe is going to thrive all of a sudden, but I think there are certain sectors that need to invest and that have drivers for demand growth that will benefit from cost of funding being lower. So we're trying to find those areas where the companies would benefit from a more accommodative monetary policy. But as you say, in terms of European growth, whether it can surpass US, that's a bigger question, but perhaps a less relevant one for us because we are more concerned about stock picking and bottom-up analysis. Then the second part of the question was that how will lower interest rates be helpful? So I guess I kind of answered that in some manner because we think that certain companies and sectors will benefit more than others.
I think that's really good. And without putting words into your own mouth, I think investors should be aware that our portfolio is quite global. So the drivers of the European economy aren't just what drives our stocks. So Koenig Cranes and stocks like that have very much international interests. Let's move on to the next one. How do you expect the changes to benefit performance, which has been tough in recent years, and thereby reduce the discount? The dividend is welcome, but the trust has lagged some of its other peers. Minna, perhaps you'd like to talk to that question.
Yes, absolutely. And I regret that performance hasn't been stronger in absolute or relative terms. I can assure you that at least from our perspective, it hasn't been due to any lack of effort or skill by the team, which has very strong long-term track record. But it was also a year of transition. We have clearly the trust has the portfolio of the trust has definitely experienced the style headwind, and the interest rate hikes haven't helped. To some degree, as we mentioned before, the reversal of that we think will help. But also when we look at the potential for the specific companies that we're invested in terms of growth in EPS and growth in free cash flow, return of that to shareholders, we really think that the trust is well positioned going forward, not totally dependent on macro trends, but also perhaps the asset class may benefit from the reversal of some of the macro trends we experienced in the last 3 years, which has been a perfect storm.
Thank you, Minna. That's been very illuminating. Just moving on to the next question. Keep them rolling. There's plenty of time left. Is stock liquidity an issue? We're investing in small and mid cap, of course. Does it pose risks, and how do you, as the portfolio manager, how do you manage liquidity in the trust?
Liquidity is very important within this investable universe, particularly small, a bit less so on the mid cap side. So when we think about liquidity and when we think about investments, given the investable universe where it sits, it needs, if liquidity was proving to be quite limited, we would need to think really hard about how attractive the investment is to go into the trust, because the opportunity cost of that is quite big if you can find more liquid and just much more attractive investment opportunities. So I would say that there is definitely a floor on liquidity we would be looking for, and we would be managing, position size and the attractiveness of the investment accordingly. So liquidity is probably one pillar within if we had to triangulate between valuation, conviction, and liquidity, would be one pillar within that triangle in decision making.
Thank you very much. Next question coming in. You've outlined quite a bullish outlook. The trust has some gearing. What's your view on structural gearing? And does the 6% yield requirement, does that limit the element of gearing at all?
So there is, we are deploying gearing, and because we believe in the long-term prospects of the asset class, we believe that there should be a structural level of gearing that should be in place at all times. It's very difficult to time the entry and exit to kind of market time the price of an investment. Similarly, it would be true for investing in the trust. But if you think that longer term the returns are going to be strong, then why not have the gearing? On the other hand, we can definitely manage it based on a lot of information that we receive, data and our view of macro, and that can be brought down or up. But currently, we think that this is a good level. And again, it's kind of we would like to keep it structurally there because we believe in the asset class.
Thank you for that. So we've got a triple question from someone, so I'm going to break it into three parts. So how much of the trading volume in the investment universe is driven by passive investors?
I'm afraid I don't have the answer to that question. That is a factual question which we can get back to you on looking, because I wouldn't want to say something that's inaccurate.
No, I would agree with that. I mean, my instinct would be that the trading volume from passive investors would be lower in small cap than it is in large cap, but probably significant. But we can revert to you on that. The second question is, what has been the direction of investment flows in allocations, particularly from retail investors? I mean, maybe I can help a little bit with that.
Maybe. Again, it's not data I have off the top of my head.
I would say that, and I'm aware of this because I deal quite a lot with our investors, not just in investment trusts, but elsewhere. I would say that the flows in equities in Europe have been out in the last few years, mirroring with the market development relevant to the US. There's been quite a big switch going on, but out of Europe into the US. We reckon that creates opportunities rather than anything else, and valuation opportunities. And I would say that flow dynamic has been particularly marked in small cap. So we would have seen investors disinvest from small cap purely for asset allocation reasons, or reduce their allocations to small cap for asset allocations reasons. And that would be particularly true of retail and wholesale investors, less of institutional investors. So the third question from the same questioner, which is another good one. Any comments around price discovery within the market?
I'm not sure exactly what this is alluding to. This is it more a question around how we execute the trades?
Let's leave. What I'm going to do is I'm going to invite the questioner to perhaps put a little bit more detail into the chat, and then we can address that one because we've got a few minutes. And then we're ever optimists. So a question here: do we the share price is starting to creep up? Do you expect this to continue in 2025?
It's difficult to call that because we can't control the share price. What we can control is the performance of the underlying fund, and that is what we are aiming to do every single day in terms of providing outperformance for our shareholders. So we would hope that the share price would reflect that in time.
Yeah, and I think there are compliance limitations on how much we can say about the way we think it's going to go forward. But we're clearly working to generate good positive returns for you, and I think Mine has painted an overall picture which is quite positive about the prospects for recovery in European small and mid cap, and therefore in the portfolio. Question here. How are company share prices responding to operational updates? So when companies actually come out with a statement, how does the share price react at the moment?
So there isn't just one answer to that question because it very much depends on. So sometimes it's as you would expect. They come up with a positive update, and the share price reacts positively because either the earnings are increasing or there is a reason to rethink the rating of the stock. Then there are other instances where if it's a very crowded trade, you can see a short squeeze that's maybe counterintuitive, or you can see the reverse of that. It's a very crowded trade, so even good news is not good enough, and hence, the valuation probably reflects that to some degree. So it depends on both investor sentiment as well as the underlying fundamentals of the stock.
That's a good one. So I think this one is quite a quick one to answer. Does the fund hold only ordinary equity, or do you hold preference shares and other things like that?
There is no reason why we couldn't own preference shares or ordinary shares. So I think I can't think off the top of my head if we hold any preference shares, but I don't think there's an exclusion, so we would be allowed.
Yeah, we are typically equity investors rather than bond investors, so we wouldn't hold preference shares which would behave like bonds, for example. But if the preference shares are all that was available, then we could do that. That's all I have at the moment. Mine, you've been very generous with your time and very clear with your answers. So from my perspective, thank you very much. Paul, would you like
Fantastic.
to?
I'd echo that. Thank you. Thank you very much. Thank you very much indeed for your responses to so many questions. And of course, any further questions that come through, we'll be able to pass those on to you, and we can publish responses where appropriate to do so on the Investor Meet Company platform. Just before redirecting investors to provide their feedback, which I know is particularly important to you, Francis, I could just ask you for a few closing comments, please.
Yes, thank you very much indeed. Yes, we painted a picture of recovery in Europe, of recovery in small cap, which has been a tough place to invest. So those of us who stuck with us in that period, I'd like to thank you for that. We are working very hard to take advantage of the best opportunities in the market. Mine has a very clear and structured style, which has proved extremely successful over the long term. And we're working hard to ensure that that's reflected in future long-term performance, so we can do the best job we can for you. Thank you for your time. Thank you for your questions, and thank you again, Mine.
And thank you very much, Francis, for helping moderate this session. And thanks everyone for listening and for your very interesting questions. It's been a lovely debate.
Fantastic. Thank you both indeed for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. So don't take a few moments to complete. I'm surely greatly valued by the team. On behalf of the team at European Asset Trust PLC, I would like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.